Atlassian's billionaire co-founder and CEO, Mike Cannon-Brookes, just pulled the trigger on a massive, pre-arranged plan to buy $250 million of his own company's stock on the open market. And this move, it points to a glaring, massive disconnect between the market's recent panic and the actual underlying fundamentals of the business. We're looking at a situation where Wall Street's fear has created a profound tension with the hard data coming straight out of the company.
Just let that number sink in for a second. $250 million. A nine-figure personal bet is the absolute ultimate proof point of insider conviction. It immediately begs the question, what exactly does the CEO see that the broader market is completely missing right now? Why is he backing up the truck at this exact moment?
Well, the disconnect here is just staggering. Historically, Atlassian has commanded a serious premium, trading at an average enterprise value to revenue multiple of 17 times between 2021 and 2025. But recently, fears over a temporary transition in their data center business have completely crushed that multiple down to a historic low of just 3.5 times. The market has violently repriced this stock, which sets up what looks to be a highly asymmetric opportunity. So the crucial thing we have to figure out is whether this compressed valuation is actually justified or if the market has severely mispriced the asset.
To figure that out, let's get some quick context on the engine behind modern work. To really grasp why this company is so relevant right now, you have to look at how they actually make their money. They deliver a unified system of work, basically software tools that connect technical teams, IT departments, and non-technical staff across an entire enterprise. They're heavily diversified globally, pulling in 48% of revenue from the Americas, 41% from EMEA, and 11% from the Asia-Pacific region. Now, their core products, Jira and Confluence, are the absolute industry standard. They're used by over 350,000 customers, which includes more than 80% of the Fortune 500. But here's the real kicker. Those Fortune 500 customers, they represent only 10% of Atlassian's total business today. That means their enterprise monetization is still in its absolute infancy. The headroom for expansion within the biggest companies in the world is just massive.
Which brings us to what's actually driving the business today, and honestly the moat that the market seems to completely misunderstand.
Look, this isn't just about basic project management software anymore. Customers choose Atlassian because of its open, vendor-neutral platform architecture. Once a company sets up Jira as its database of record and Confluence as its organizational brain, the switching costs become incredibly disruptive and wildly capital-intensive. And the secret weapon beneath all of this? It's called the Teamwork Graph. This is a proprietary architecture mapping over 200 billion objects and relationships across an enterprise. Because Atlassian has spent more than 2 decades mapping exactly how teams collaborate, they have an unparalleled data advantage. In the era of enterprise AI, context is literally everything. This 20-year data moat gives them the ultimate context for AI, which frankly renders generic point solutions totally obsolete and cements Atlassian's competitive edge.
And because of that deeply embedded teamwork graph, Atlassian's new AI assistant, Rovo, is a beast. It can ingest all that corporate context to generate up to 44% more accurate responses, all while consuming 48% fewer LLM tokens than standard models. That kind of token efficiency is a huge deal. It minimizes infrastructure costs while maximizing output quality. It creates a massive economic advantage and a software modernization flywheel that competitors simply cannot replicate.
Okay, so if this moat is so impenetrable, why did the stock take such a beating earlier in 2026? We have to look at the central conflict here.
Let's honor the bear case for a minute, because Wall Street had some very real fears. First off, management guided for a 17% decline in fiscal year 2027 data center revenue. They're intentionally winding down their legacy self-managed products to force a shift to the cloud, but optically, a revenue decline always spooks the market. Second, the company went through a fairly painful restructuring, laying off about 10% of its workforce, which resulted in a $223.8 million charge. Third, there has been genuine macroeconomic pressure on seat expansion, particularly in non-technical departments. And finally, there's this broader, looming fear that generative AI could just commoditize basic workflow software altogether. So you take those optical drags, combine them with macro anxieties, and you get a perfect storm of negative sentiment.
But then the evidence shifted, specifically with a massive blowout in Q4 of fiscal year 2026.
On August 6, 2026, Atlassian basically dropped a hammer on that entire bear case with a remarkably strong finish to the fiscal year. Total revenue for Q4 hit $1.766 billion, absolutely crushing analyst estimates of $1.66 billion and growing 28% year over year. That was led by a massive acceleration in cloud revenue, which surged 31%. Non-GAAP earnings per share came in at $1.87, obliterating the $1.50 estimate. But the real showstopper? A dramatic return to standard GAAP profitability, with a 12% GAAP operating margin. Management was quick to point out that this beat was driven by core Jira seat expansion and high-margin cross-selling, not just one-time pull-forward migrations. The market definitely noticed, and the stock skyrocketed over 30% in after-hours trading.
And if you want a crystal ball for future demand, look no further than this number. Remaining performance obligations, or RPO, which is essentially their contracted backlog, rocketed up 44% year-over-year to $4.817 billion. That proves Atlassian has a highly visible, contracted runway that completely defies the broader narrative of a software spending slowdown.
Moving from the hard numbers to the qualitative side, let's take a look at the institutional scorecard.
When we synthesize the fundamental quality of this business, Atlassian earns a very strong blended rating of 8.4 out of 10. Let's break down why. Management alignment gets an elite 9 out of 10. The founders have dual-class voting control, which ensures long-term stability, and the CEO's $250 million open market buy is quite literally the ultimate signal of conviction. Revenue quality also scores a 9, driven by high cloud net retention rates above 120% and that massive 44% RPO growth we just talked about. Profitability scores a 7, mostly because heavy stock-based compensation has historically been a real drag on their GAAP numbers. However, with that Q4 transition to a 12% GAAP operating margin, they are finally turning a massive corner. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of the screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Now, let's dive into the scenario analysis in our 5-year framework. But before we get into the math, I need to state this clearly. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
Let's break down the underlying assumptions here. In our base case, which we assign a 60% probability, Atlassian successfully navigates that data center transition, Rovo AI monetization scales effectively, and revenue hits roughly $13.8 billion by fiscal year 2031. Assuming a 26% free cash flow margin and a 28 times multiple, that implies a share price of $392.75. In the low case, modeled at a 15% probability, we see severe execution friction. Cloud migrations slow down, competitors step in to take market share, margins compress down to 20%, and the multiple drops to 20 times, landing the stock at $156.80. But in the high case, which we give a 25% probability, AI adoption absolutely explodes. The teamwork graph drives massive operating leverage, pushing margins up to 30%, and a premium 32 times multiple pushes the share price to an impressive $640.78. When you probability weight those 3 scenarios, it spits out a target of $419.37. Against a post-earnings starting price of roughly $143, that represents a highly asymmetric 193% potential upside over the next 5 years. And remember, if you want to dig into the exact assumptions and see the math driving every single cell of this model, you can view the full detailed report at flash.stocksentinel.ai.
But we have to be objective here. Let's get into the risk analysis and look at what could actually break this thesis.
No investment is without friction. So what early warning signs are we watching closely? The 3 main ones. First is the data center trough. If sequential revenue in that segment drops more than 20%, it signals delayed cash flow, even if the long-term contracts themselves remain intact. Second is enterprise seat contraction. If cloud net revenue retention drops below 115%, it means their push into non-technical corporate divisions has stalled out, which significantly reduces their terminal market value. But the catastrophic risk? Generative AI commoditization. If Rovo AI credit consumption drops, it means the teamwork graph is failing to maintain its contextual edge and
cheaper point solutions are eating into their core workflow layers. That would structurally and permanently lower their margins.
So bringing it all together, let's do a final synthesis and resolve this massive market disconnect.
How do we make sense of the market's panic versus Atlassian's reality? It boils down to 3 crucial takeaways. First, those Q4 fiscal year 26 results were not just a fluke, they represent a structural inflection point in standard GAAP profitability, proving just how resilient this business model really is. Second, the 20-year history embedded in the teamwork graph creates an enterprise AI moat that competitors just can't replicate overnight. And third, the current compressed 3.5 times valuation multiple completely ignores the massive 44% momentum we're seeing in their contracted backlog. Rovo AI enterprise adoption is hands down the single most important metric to watch next. This combination of accelerating fundamentals and a crushed multiple perfectly resolves the curiosity gap of why Mike Cannon-Brookes is enthusiastically backing up the truck for $250 million of his own stock.
If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. The CEO just made a $250 million bet that Wall Street has this all wrong. The question is, are you going to watch from the sidelines or dig into the data yourself? Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.